Okay, so it looks like we are live here. Patrick Queally, your friend in the mortgage business, coming to you with another edition of the Wicked Awesome Report, joined by my co-host, Declan O'Toole from Select Real Estate. Good morning, Declan.
Good morning, Patrick. How are you?
I am well, and yourself?
I'm doing good,
Good. So this is another edition of the Wicked Awesome Report. Talk about all sorts of business-related issues, somewhat real estate-centric, and today we're going to be talking about different types of property inspections. But this is, again, the Wicked Awesome Report. We broadcast this every Tuesday and Thursday at 10 a.m. So please give us some comments, some likes, some shares. Check out the Facebook page for Wicked Awesome Report. Give that a like and you'll be notified when we do have new videos that come up. And we're always looking for different people to come and join us on the broadcast. So if you're a small business owner, in particular, we'd love to hear from you, get some information on how you're dealing with the current pandemic and how that's impacted your business, and join us and get some exposure for your business. So if you fall in that category or know somebody that does, please reach out and let us know. We'd certainly love to have you on the broadcast. So Declan, today we're going to talk about property inspections.
Yeah.
So over the course of a real estate transaction, there are a number of different inspections that take place, and they're all for different purposes. There is some overlap, but each inspection has a slightly different purpose and a different, target audience or who that report or inspection is intended for. So I think maybe the best thing to do is to sort of go sequentially throughout a real estate transaction as to what inspections are done and when. So typically the first inspection that happens is a home inspection. So a buyer has made an offer, seller has accepted that offer, and buyer wants to have the home inspected, really, to check out the safety and soundness and to check out all of the mechanical systems to make sure everything is working correctly. So Declan, chime in a little bit here. What are your opinions on just home inspections in general?
So first off, as you said, Patrick, home inspection, you put in an offer, you do the home inspection before you do the purchase and sale. I consider the home inspections almost like with a car, you take it for a test drive. Yep. Almost as if they let you take it home for a day and then bring it back, and you show it to your mechanic. I think home inspections are certainly for a buyer, for a property, particularly if the property is not a new property. You're looking at you'd be surprised. Almost I've been to maybe 300 thereabouts home inspections over the years. I think on 3 occasions they didn't find something. Like that's literally 3 occasions. 2 brand new build, 1 that was existing. One of them happened to be my own, just letting you know, because kept it in good condition. But so essentially, home inspection will find, if you're as a buyer, you don't see everything. When you do your walkthrough, you do open house, you make an offer, you don't know what you're buying. So home inspection can be very important for you as a buyer, for the purpose of knowing what you're getting. Now, it's not always. Some cases somebody will make an offer and then they do the home inspection, and then they find that there's certain issues in the property, and then they try and they ask for some concessions from the seller. That might well be the case, but even one of the important things from a home inspection is when a home inspector goes through, they'll go through and then they'll pick out items that you need to look at and address over time. So it might be your systems, it could be the ventilation, etc.
Yes. So it's not necessarily an immediate repair that's needed. It's just sort of a heads up. Hey, it looks like the furnace hasn't been serviced in a couple of years. That's something that you're going to want to address when you take ownership of the home. And
even if they don't see an issue with the furnace, that home inspector can say, hey, look, you need to have somebody in once a year. They point out things. They basically give you guidelines. Okay. For how you should take care of your house, basically take care of it going forward, and what you should do as steps to keep it in good shape.
So to jump back to sort of that car analogy where you're taking it for the test drive, home inspector is to a certain degree giving you an owner's manual, or maybe a reduced version, a summary of an owner's manual of the sticker on the windshield, change the oil at 3,000 miles, is giving you sort of that heads up as to what you should be
Yep.
paying attention to.
Change the oil. If you know that, maybe you don't know to change the spark plugs at 100,000 miles, right?
Yeah.
So essentially that's part of it. The other part of it is, of course, obviously, is to see if there are any issues with the property, particularly if it's something that might be structural or otherwise. They can't get too deep into it, but they're there to find those issues. Stuff that could cost you $10,000, $20,000, $30,000, you know, that you didn't know you were getting into.
Right.
On home inspections, it's interesting, you know, as I said, I've been 300 or thereabouts home inspections. In the current market environment, kind of sidetracking a little bit, is you're finding more and more offers that are coming in not looking for a home inspection. And it's not because the buyer doesn't want to do a home inspection, it's to give them a competitive edge with the seller, because then it's one less inspection the seller has to deal with on the property.
Right. So an offer that comes in and the buyers are not getting a home inspection, there's less fear on the side of the sellers that something's going to come up, there's some sort of repair or something they're going to need to do to keep those buyers happy when purchasing that home. Okay.
And the thought there is, let's say you make an offer and there's a multiple offer situation, and let's say you make an offer for, I don't know, $500,000 on a property and somebody's at 505, and all things being equal, you may still have the better offer if you don't have a home inspection.
We talked about it on a previous show. It's not necessarily, you know, the highest dollar amount of an offer is the best. So the term highest and best,
there's the best
more
there.
Focuses on highest, but really best, you know, can mean some different things. But, you know, I'm always apprehensive for a client of mine that's purchasing a home if they don't have a home inspection. So I always advise people, you know, if they want to get that competitive advantage, like you mentioned, of waiving the home inspection, still get a home inspection done, but it's for informational purposes only.
Right.
So you can't take that home inspection back to the seller and say, hey, X, Y, and Z needs repair. You're really just doing the home inspection so you know, once you take possession of the home, that those are the repairs or those are the items you need to have done.
And something that you can also do, it doesn't always work, but if you've got a home inspector you can line up pretty quickly, you set it up so that you get a home inspection done within 24, 48 hours, within a period of time that hopefully, let's say it's a Tuesday that offer has gone in, that from the seller's perspective, they can still put it back on the market that weekend or keep it on the market.
Right, yeah, so speed, again, we talk about best, sometimes speed is what makes an offer best, not necessarily just the dollars involved.
Right, exactly.
Okay.
Exactly.
So home inspections, so that's usually the first type of property inspection that's done. So after a home inspection and all of those items, whether there are repairs or not, you know, all the details have been agreed to by buyer and seller, purchase and sales agreement has been signed, and consumer applies for financing to buy that home. Now, every mortgage lender is going to require a property appraisal be done. Now, the appraisal is different from a home inspection. That's really sort of the point of today's call, highlighting the I guess some of the similarities, but really more what the differences are in the different types of inspections. So an appraisal is required by the lender to be done. And the appraisal basically has two major functions. Number one, to determine what the fair market value of the home is. And number two, to show to the lender also what the condition of the home is. Okay, so let's deal with fair market value first. So let's say someone's purchasing a home for $500,000, just pick a number. Okay, and so the appraiser is going to go out and inspect that property and make a comparison between the property you're buying to other similar size and style homes that have sold recently. So try to make an apples to apples comparison here. So Declan, if you're buying a colonial style home, when an appraiser is trying to determine what the fair market value of that home is, not going to compare that colonial to a ranch or to a Cape style house. So in order to determine the fair market value, you want to compare it to similar type property. So compare a colonial to a colonial, a Cape to a Cape. Now, sometimes you can, there's a little bit of crossover there. So a Cape can be a little bit similar to a ranch, style house. So you can make some crossovers like that, but ideally To determine what the fair market value of the home, you want to have a similar style, and also a similar size. So if you're buying a home for, for 500,000 and it is a 2,500 square foot home, it's really not, it's not fair to compare that to the, 1,000-foot, ranch that's, down the street. It's a completely different type of property.
Well, that's something. I mean, appraisers don't have an easy job. You're looking at, and you mentioned that just size, for instance, the value of a property, the price per square foot goes down after you get the value of the kitchen, the bathroom, the bedrooms, and then as the square footage goes up, the actual value of each extra square footage, and again, all things being equal, goes down over time. So a small property, if you're just going by price per square foot, might actually throw it off. I think what appraisers do, it is sometimes I've seen that, and it's one of the reasons that I do prepare comps for appraisers. And of course, we had Adam Weiner on here before. He says 50% of the time you take the comps, 50% that you don't, or 50% of them do. But there are situations where it might be very hard for an appraiser to. You have the different styles of homes, the different sizes, and sometimes you're looking at a square peg in a round hole. They're not allowed to put square pegs in round holes.
Exactly. So, again, the basis for determining that value is a comparative analysis comparing other similar size and style homes. And you're right, you can't put the square peg into the round hole. It's just as much an art as it is, a science. And the appraiser does have a difficult job to, put an opinion of value, to put a number on that. What is that fair market value of the home? So again, comparing similar size and similar style homes, but also recent sales. So, the market changes over time. We're in a vastly different market now than we were 6, 8 months, 12 months ago, a year ago. Okay, so it's a recent sale. So ideally, you want to see a sale that has taken place for a comparable property within 6 months. Okay, the closer or the shorter the timeline, the better. But sort of a rule of thumb is about 6 months. You can go out a little bit further in time, but the further back you go, to a certain degree, the less reliable that data becomes. Okay, and also location. So the comparable sales should be within the same town as the property in question that's being financed, ideally within a 1 mile radius. But again, similar to time, you can go out further in space or in distance, but the further away you get from the property, to a certain degree, the less reliable that information becomes. You want to have comparable sales that are essentially in the same neighborhood. So if we talk about predominantly urban areas, okay, you go 2 or 3 blocks in a different direction and it's like a completely different market. So that's why a lender wants to see comparable sales that are close to the property that's being financed.
So, and then of course, getting back to the second part of this, Patrick, is condition, right? So what are the things to look for? What are the things that you can do if you're selling your property, to make sure that it passes, or at least that it doesn't get snagged on some of the conditions?
So we were talking earlier before we started the broadcast about sort of this, generic term. So some people want to buy a home that, quote unquote, needs work. Okay, so needs work means a lot of different things to a lot of different people. So I'll give you a couple of different consumer perspectives on that, and then a lender's perspective on an appraisal on a property that needs work. So a consumer that says that they want to buy a property that needs work, generally their intention is basically to force equity. They want to buy a home, make some upgrades themselves to increase the value of the home. So again, a couple of different opposite ends of the spectrum here. For example, somebody may want to buy a property that needs work, and their intention is, hey, the property is vacant. It suffered from some vandalism. The copper pipes are missing. There's holes in the walls and the ceilings. Everything, including the kitchen sink, has been ripped out of the property. So to some people, that's a definition of needs work.
Fixer upper.
Other people, that needs a lot of work. So to other people, needs work means, hey, it's the shag carpeting and the wood paneled walls and the avocado green tiles in the kitchen and bathroom, cosmetically. Yeah, the wallpaper, is in most of the rooms, so to most people, or to a lot of people, that's their definition of needs work. It's really just cosmetics. It's the fixtures are all in place and functional and working. They're just outdated. Okay, so those are sort of two different opposite ends of the spectrum when a consumer says they're interested in a property that needs work. Now, from a lender's perspective, unless it's a construction or rehab type loan product, lender doesn't want to lend on a property that needs work. So understand that the job of the appraiser is to document for the lender, number one, what the fair market value is, and number two, what the condition of the home is. So a lender wants to see that that home is essentially in move-in ready condition. Okay, that's the collateral for the dollar amount being borrowed to purchase the home. So they want to make sure that the property is in good condition. And what does good condition mean? Well, this is where we get into more kind of the art than the science of how the appraiser writes up the report. So basically, all the fixtures need to be in place and operational. All the mechanical systems need to be working. Basically, it has to be in a condition where you can move into the home today and live there without needing to bring a construction crew with you. Okay, so sort of the two examples, leaning more towards, cosmetically it may be outdated, but as long as everything is there and functioning, that's perfectly fine. Now, the appraiser is more than likely going to give it a condition rating here that, based on the age of the fixtures, that, the property is worth maybe a little bit less than, a similar property next door that has already been updated. So again, the appraiser's job is to take a look at the fair market value as well as the condition of the home, because the lender wants to make sure, if you're buying that house for $500,000, Declan, they want to make sure that the fair market value is $500,000. If the appraiser says, yeah, Declan wants to buy this house for $500,000, but in the neighborhood, nothing's sold for more than $425,000. It's not worth that much. Well, as a lender, we're going to say, Declan, you're out of your mind. We're not going to let you buy this house for $500,000 if it's only worth $425,000 in the current market.
Right. And then there's other things that you have to watch for. I believe in FHA loans are things like broken windows, peeling paint. There's certain things that might trigger. I suppose it gets written up by the appraiser, and the bank has some issues with it. Yeah.
So different types of loan products have different requirements in terms of the property being in habitable condition. And around here, one of the most common things is on an FHA loan is peeling paint. So interior or exterior, if there's any chipping or peeling paint, that needs to be addressed. Okay, so we started off talking about home inspection and any potential repairs. Now on an appraisal report, if there are repairs that are required to make that home habitable, and you may not think that chipping and peeling paint affects whether the home is habitable or not, but for the loan underwriting guidelines, it does for an FHA loan. Though there very well may be some repair items that the seller needs to take care of, before we get to the closing table, and sometimes that's another negotiating point. Midway through the transaction, sometimes some of those details need to change, and you need to renegotiate, because Declan, you want to buy that home for $500,000, but it only appraised for $425,000. Well, that's an issue. Lender's not going to give you mortgage financing purchasing a home at $500,000 if the appraiser says it's only worth 425.
And that brings up an interesting situation, Patrick, is what do you do, right? So you're at 420, you're buying the house, it's worth 425, you're at 500,000. That's a fairly steep difference.
Yep.
So you've got some options. You can walk away, right, from the deal because you didn't get the appraisal. If you have a mortgage contingency in there.
Yep.
So for those that haven't gone through this process, you had a purchase and sale contingency, which was very often due based on the inspection. The house was up to scratch, you get a purchase and sale contingency, you get back out because of your home inspection. Now you got a mortgage contingency, it has to be worth the value of what the appraiser says it is. That's one of the contingencies on a mortgage. Yep. And you could, in theory, walk away. You could also have the seller make a concession. And again, these are all common sense solutions. Does the seller come back and give you $75,000 off the price, make some kind of a concession that way? Yep. Or do you put more cash into the bag, as in come up with 75 or meet them somewhere in the middle? So yep. It's a good point. It does bring up, as you said, a renegotiation is not just about peeling paint, but it's also the price of the property.
So definitely, on the appraisal front, appraisers, and I would say particularly, in New England, have a difficult job. So around here, you've got different neighborhoods with different size and style homes. So it's unlike, some other parts of the country where you've got a tract of, 10 acres, and it's all similar style, size and homes that are built on that subdivision. And the values are going to range within a tight range based on, maybe what finishes are in the home. Whereas here in New England, you've got a colonial beside a ranch, beside a cape, with a Victorian 2 doors down. That's just the character of the neighborhood. Not all the homes are similar, and that's where you get into a little bit more of the art rather than the science, trying to find homes that are similar but also within a similar location. So sometimes maybe you give up a little bit in terms of the similar style to get a more accurate read on the location of that part of town. What's the real estate values in that specific area? Yeah,
that's again, that even interesting. When you're making an offer, you're already thinking about the appraisal. I've often had situations where you win an offer and then the first question that's asked, actually very often even by the seller's agent or listing agent or the other party, is, well, okay, but will it appraise?
Yeah, great. You want to pay $1 million for this house, great, but is it going to appraise for that? It's great that you want to pay that, but is the lender going to let you pay that when you're borrowing most of the money, for that transaction? Because, really, when you take a look at it, the day of closing, the lender is the one that's coming with the biggest check typically.
Right.
So the lender wants to make sure that collateral is valued appropriately.
Their investment is much, if not more than you, because they've got more money into the property.
Exactly. So again, we have the home inspection, which is really, sort of the mechanical system, safety and soundness of the home. We have the appraisal, which is to determine fair market value as well as condition of the home. Next type of inspection, which really doesn't get a lot of attention, but over my career, I've had some questions come up about, the next type of inspection, and that's an insurance inspection. So depending on your insurance company, I think it's pretty common now across the board that all insurance companies are going to do this. So you need to have a homeowner's insurance binder to purchase a home. That's your basic fire and hazard policy. God forbid the place burns to the ground, you have an insurance policy to replace the home. So the insurance company is going to want to see the property. Now, most of the time, you don't even know that this has happened. It's simply the insurance inspector, someone that is either an employee or a subcontractor of that insurance company, is given, a name and an address. They go out to that property and they snap a picture from the street. Okay, yes, this is a colonial style house or a ranch or a cape or whatever it is, freestanding building, and here it is, it exists. Okay. I've had some issues with some clients over the years where the insurance inspection has become a a problem.
Fixer uppers, Patrick.
Yeah. So when we use that term, needs work, someone buys a house that just cosmetically needs some updates, but once they got in there, they decided to do a whole hell of a lot more than just cosmetics. So one client comes to mind, and we'll leave the names out to protect the not so innocent. So a couple of days after purchasing the home, it was a colonial style home with a small little farmer's porch at the front, and what they had wanted to do was create a much larger farmer's porch and sort of wrap around the side of the property. Great.
Nice idea.
Well, they own the home. Okay, so they already closed. It was their home. They owned it. They went at it, ripped off the porch. So now you've got the front door to the property without any stairs or anything coming down. Needs whatever 4, 5, 6 steps to reach ground level. The entire porch is ripped off. So technically, and I understand the insurance company's perspective. You open up the front door and you've got a several foot drop before you hit the ground without any stairs. So they had ripped off the porch, and it was their plan, and that's what they were doing, was building a new porch. It was going to be a larger wraparound, certainly going to look nicer, add some value to the home, but it came down to timing. So when they ripped that porch off, the time span between when they ripped it off and when they put the new one on is when the insurance company had their inspector come out and take a picture of the property. Now, Declan, put yourself in the shoes of the insurance company. Pictures taken of the front of the home. The front door is 4 or 5 feet up off of ground level, and there's no stairs.
And there's somebody living there.
Yeah. That's a safety issue. Okay. Yeah. So permits were pulled, everything was fine, everything was done, was being done according to to code, but it sort of freaked out the insurance agent a little bit, and another inspection had to be done once the new deck, the new porch was put on, just to say everything's fine here. So whether you know it or not, as a homeowner, the insurance company is going to drive by the property at a minimum and take some pictures to make sure that, at least from the exterior, property looks like it's in good shape. You don't have half of the house that's falling off the foundation, or you're not missing a whole front porch. And sometimes too, when you're purchasing a home, what I see happen, not so often anymore, but for a while it was happening a lot, some of the electrical service. So some of the older homes that still have knob and tube wiring. I mean, believe it or not, that still exists. That's still out there. So it is a safety issue from the insurance company's point of view, really more for, fire concerns. Okay. And an insurance company is either not going to insure you in some cases, or is going to require that you upgrade that from knob and tube and fuses to 100 or 200 amp service with what's that wiring called? The Romex? Is that what it is? Romex, a modern wiring rather than knob and tube, and they're going to require that be done within a certain period of time, and they're going to inspect it and make sure that it actually has been done. You can't just tell them, oh yeah, it's all upgraded, I'm all set, we took care of it. No, they're going to require that inspection.
That's something as well, Patrick, is again, it's early on, right? You're not dealing with insurance inspection, but early on, before you make an offer on a property, it'd be good to know if there's knob and tube in there, or if it needs upgrades. Sometimes maybe it's a street family and it doesn't have a common area electrical panel too. Yep. With the insurance inspections, you're right. Typically, the average person buying a home doesn't see them, but I know on new builds, they will come and they'll check every single safety item, because again, they come in and they do a point by point, room by room, and they basically go into, they check all those systems out. Yep. But again, these are things that happen down the road, so. Yeah,
and again, sort of going back to the first type of inspection, the home inspection, even if it's only for informational purposes only, I certainly recommend everybody get a home inspection done so you can identify these things, so that it doesn't turn into an issue when you're ready to close on the property, and lo and behold, well, you can't get insurance. And
Right.
if you can't get insurance, you can't close on the financing. So no lender's going to close on a loan without, homeowners insurance being in place. Because again, God forbid, the place burns to the ground. What's the value of the collateral? Well, nothing if you don't have insurance on it, so it can be rebuilt. So again, just keep in mind, after you purchase a home, more than likely there's going to be some sort of an insurance inspection done, and that might be as simple as just the inspector drives by the front of the house, stops in front of it, takes out the camera, takes a picture, and yes, the home is in place, and it's not falling off the foundation, no one's ripped off the front porch, no obvious safety issues visible from the street. So that's the third type of inspection. Fourth type of inspection can be somewhat controversial, okay? And that's a tax assessor's inspection. So while the appraisal is for the lender to determine what the fair market value of the property is, as well as the condition, the tax assessor's inspection is to determine what that city or town is going to use as a valuation for tax purposes. Okay, so it's what your real estate taxes are based on. So real estate taxes are going to be different from town to town. It's a certain dollar amount per $1,000 of valuation, and basically as a buyer, you want the appraised value to come in as high as possible and the tax assessment to come in as low as possible, because the tax assessment, that's what your real estate taxes are going to be based on. Okay.
So for instance, Patrick, just to speak to you dollar amount, just ballpark, I know in Boston it's about $10.56 per $1,000. So let's say, for argument's sake, your property's worth $100,000. If you're getting it for $100,000, let me know. I'll buy it.
If you can buy for that, buy two of them.
Exactly. But for every $100,000, that's $1,056 or $1,056 worth of taxes you pay on that property. So they're doing it just to give an indication of what you're looking at. So multiply
Sure.
as you go up. Every 100 goes up another $1,000. That's Boston. It changes obviously town to town.
Yeah, every city and town has their own tax rates as to how they value that property and what the amount of taxes are going to be. I don't know for certain, but it seems that quite often sort of the trigger point for a town to reassess or update the valuation of that property for the tax rolls is when a property is sold. Okay, so when a sale takes place, that's a matter of public record. It's recorded at the Registry of Deeds, and anybody that still subscribes to the newspaper, a lot of times those real estate transactions are actually available in print as well. So I think that it is a fairly commonly accepted principle. Whether it's true or not, maybe we'll have to get someone on from a real estate tax assessor's office if they're willing to be interviewed to talk about it. But I think it's a fairly commonly accepted idea that when a property sells, that's a trigger point for a town to go out and reassess it to make sure that they're capturing as much of the tax dollars as possible for that property. So again, there's a difference between what the appraised value is and what the tax assessed value is. I've certainly had circumstances where consumers have bought a home. Let's say they bought a home for $500,000, and for whatever reason, the city or town has the home assessed for $600,000 or $700,000 or $800,000. It's substantially higher. Well, you can go to the tax assessor's office, and it's called an appeal. You can appeal that opinion of value, and I strongly recommend bringing an appraisal and whatever other documentation. The city or town tax assessor's office is not necessarily going to accept that as evidence per se, but it certainly sort of helps your fight here a little bit to have some additional information to appeal that value. Now, a couple of important points I want to bring up about taxes and real estate tax exemptions. Okay, so Declan, I know you do a lot of business in the city of Boston. If you're occupying a property as your primary residence within the city, you can get what's called a tax abatement. So the city of Boston offers basically a break, a reduced tax rate, if you're occupying that property as your primary residence. Now, off the top of my head, I don't know what the percentage is. Do you know what that exemption works out to, Declan?
I don't have it top of my head. I know it's...
Yes. So there is some calculation, but basically the bottom line is you get a break on your real estate taxes. Okay. As far as I know, go ahead.
It's significant. It can be significant.
It can be, yeah. So and especially for any municipal workers. So within the city of Boston, if you're working for the city, so basically if you're a city employee, whether that be police or fire or any of those type of municipal services, if you're taking a check from the city for employment for a certain number of years, you're required to live in the city. Okay. And I think that's something that's great. That certainly has changed for the better the character of a lot of neighborhoods.
So just a quick one, Patrick. I looked it up just while we're talking. Currently this year, the exemption is for homeowners is up to $2,879 or $2,880. So
okay, so $2,800. Okay, so that's a decent chunk of change for a lot of people. So as far as I know, within the city of Boston, you have to apply for that exemption, so it's not automatic. You do have to apply, and there's only one time of the year. I want to say for some reason, I think it's before February 1st. I may be mistaken, but you do have to apply and basically prove to the city you are occupying that as your primary residence, which is fair. You want to, they're going to need a, utility bill or something else to prove, you're actually living there and in order to get that abatement. One of the other important abatements that are out there are for our veterans. So veterans can get real estate tax abatements, and specifically if they are disabled veterans. So if they have any disability ratings from the VA, they can apply to have a real estate tax abatement. So I work with quite a number of veterans, and quite a number of those veterans have gone into work in the police and fire departments, and they're not aware of that abatement. So not only are they getting a real estate tax abatement for living in that property as their primary residence, because of their veteran status and because they have disability rating from the VA, they can reduce their real estate taxes even further. So, and rightly so. I mean, if they put their lives on the line in service for the country, least they can do is get a little bit of a break on their real estate taxes. So, that's something, again, that is not automatic. You do have to apply for it.
I think an important thing, again, the difference between I have all the time with buyers. There's an appraised amount and an assessed amount. They are different. So, what somebody assesses on your property. So, getting kind of swinging back in a different direction, Patrick, was like,
yeah, go ahead.
Somebody's looking at a property, looking to buy it. I often have it might be on for $700,000-800,000, and say, "What? It's assessed at $550."
Yeah,
that's a previous. Trust me, it will get assessed for more after it sells.
yeah. So. And that's something that happens quite often after someone buys a home, place gets reassessed, real estate taxes go up, and then a lot of times the consumer's mortgage payment changes because the payment they're making every month,
escrow,
part of that is escrows for real estate taxes. So the loan servicer is collecting money every month. A portion of that is going towards the future real estate tax bill. So if that tax bill goes up, well, I mean, I know sometimes math is hard, but if that if that number goes up, well, just by default, the loan servicer needs to collect more money from you as the consumer in order to pay that next and now higher real estate tax bill that's coming out in the future. So a lot of times after speaking with a consumer that has bought a home, 3, 4, 6 months ago, and their payment changes, well, yeah, it's because your real estate tax has changed. So that's something I always address with consumers up front, and let them know that, there could be some changes. So we don't want to put you into a transaction where you're literally scraping together every penny to make that payment every month. We want to give you a little bit of a breathing room, because in most cases we can pretty much guarantee that tax, that real estate tax portion of your payment is going to go up in the future.
Seldom go down.
Yeah, very seldom, unless you're applying for that one of those abatements we talked about. Right. So we have 4 different types of inspections. Let's just do a quick little recap. We have a home inspection, which is typically done at the very beginning of the transaction, and that's to take a look at what I'd call the safety and soundness of the home, and the operation of all the mechanical systems, and maybe point out any major repair issues or items that may need addressing, even if it's not a problem. Just again, coming back to that car analogy, that regular service and maintenance, check the oil, change the spark plugs, different things you need to do, service the furnace, the roof may only have a certain number of years left, so different things like that. So that's what a home inspection is for. The appraisal, that's done on behalf of the lender, or the lender's requiring it, and that's to determine 2 things. Number 1, what the fair market value of the home is, so to make sure that, Declan, you as the consumer, you're not overpaying for a property. If a home's only valued at $425, a lender's not going to let you pay $500,000 to purchase that home. Okay, so it's the fair market value, but also the condition of the home. Want to make sure that it's essentially in move-in ready condition. You don't have to bring a whole construction crew with you in order to be able to move in there. The 3rd type of inspection is an insurance inspection, and again, most consumers don't even realize that is happening unless there's a problem and they hear from the insurance company. But again, one of the common things that comes up when you're applying for homeowners insurance is the wiring, the electrical systems. Is it an older knob and tube, or is it a PBX? That was the type of wiring I was talking about. The newer upgraded wiring on circuit breakers rather than a fuse box. Okay, and then the last type of inspection is a real estate tax or tax assessor's inspection. And one thing we didn't talk about, Declan, when we talk about tax inspections is similar to an insurance inspection, they may not even come into the home. Now, right. The tax office from the city or town is going to send you a letter, and a lot of times they're going to request an interior inspection. But if the homeowner doesn't respond, or the homeowner doesn't want to let the inspector in, I don't think that they're required to, but then that tax assessor has to make their best estimation of value from the street and taking a look at what the property looks like from the exterior. So again, the tax assessment, the purpose of that is to determine what amount of real estate taxes you'll be paying to that city or town. So home inspection, appraisal inspection, insurance inspection, tax assessor's inspection.
Before, during, and after your home purchase.
Exactly. Yeah, for sure. So those are the different types of inspections, who needs them, and why, how that impacts you as a consumer, different things to be aware of. May sound basic, but those are questions I get on a fairly regular basis. So I think it's a good video, good information to put out there, a good call to let people aware, make people aware of what those differences are.
Right. Oh, sounds good, Patrick.
All right, very good. So I think we're hitting how long? Oh yeah, we've gone for quite a while here. So let's wrap up the call. I'm Patrick Queally, your host here for the Wicked Awesome Report, and your friend in the mortgage business, joined by my co-host Declan O'Toole from Select Real Estate. Thanks for hopping on this morning, Declan.
Nice to have you, Patrick.
We run the Wicked Awesome Report every Tuesday and Thursday at 10 a.m. And specifically, we're looking for some guests to come and join us. As you can see, it's not any, hard-hitting journalism going on here, but really looking for some small business owners that maybe we can highlight their business and talk a little bit about the pandemic and how their business has been impacted, and maybe shed some light on their business and hopefully help them, survive through this craziness that's going on. So if you are a small business owner, or if you know a small business owner that would like to come on and be interviewed and hang out with us for a little bit here on Zoom, would love to talk to them. Please reach out, give us a comment, a like, a share, send us a private message. That's all really that I had. So that's another edition of the Wicked Awesome Report in the books. Till next time, thank you, Declan. And hope everybody out there stays awesome. Take care.
Stay healthy.